Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open, so please give us a call on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we're very lucky to have Ben Clark from TMS Capital and also Gaurav Sodhi from Intelligent Investor. So welcome to the program. I mean, this is a time when we are seeing a pullback on the market, investors a little bit nervous in terms of what they should be doing in terms of asset allocation, because the fact is that banks and those iron ore stocks are probably the biggest weighting in most portfolios. So, Ben, how are you positioning portfolios at the moment?
We don't have any sort of weighting really to iron ore stocks, other than small holdings in BHP. And I think, Julia, like a lot of other participants in the market, we're trying to find earnings growth, which is hard to come by, and we're also looking for any sort of opportunities to buy what we consider like sort of good quality stocks with an earnings growth profile going forward. So I guess our portfolios are probably less, how do I say this, probably less index focused than a lot of traditional portfolios would be, and with bigger holdings and sort of companies that aren't necessarily in, say, the ASX 100 or something like that. We've seen a couple of opportunities, we believe, in the last few weeks. We bought a bit of NAB post the raising that they did, but still not sort of tempted to go into resources.
Okay, so a little bit of buying in banks, but staying away from the resources. Gaurav, what about you?
I'm happy to say that we've been recommending selling iron ore stocks for years now. Sort of 2 or 3 years ago, we sort of said iron ore is looking dangerously expensive and get out of Rio Tinto and avoid all the iron ore miners. After making that brave call, I'm not prepared to make a braver one, which is to buy at this point. I think we're only at the beginning of a very long downturn in iron ore, and it's going to be a very painful ride lower. So I expect that to continue. Look, it's a very expensive, difficult market. I think what we're grappling most with here is what to do with the prospect of zero interest rates. I mean, I understand intellectually that should mean higher asset prices, but I'm loath to pay more for a business simply because the rate of interest is lower. So it's a very difficult decision that investors face. I'm probably, unlike you and Ben, quite negative on banks. I mean, I agree that NAB is probably the best of the lot, but I think there's a lot of problems with Australia's banks. They don't have enough capital. They're paying far too high payout ratios. I think there's going to be capital raisings to come, and there's some potential pain for investors down the road. So that's not a sector I like either. In an environment where investors are chasing yield, the best opportunities, I believe, are in securities that don't pay a yield at the moment. So businesses with few warts, with a little bit of debt, that with a little bit of effort can clear that debt, can wipe those warts away. I think those are the companies that look a little bit more promising in this sort of environment.
Well, sounds interesting. Look forward to talking more about some of those companies later in the show. We do have our first caller on the line, so let's go straight to Vic from South Australia. Vic, welcome to the program. What's your question for our panel tonight?
Oh, good day, and thanks for taking my call. I realise the oil and gas sector are very, very volatile at the moment, but I'm just wondering what your panel thinks of Santos and its longer term.
Sure. So looking at Santos, traditionally producing from the Cooper Basin, but of course that LNG potential there as well. We've seen a massive sell-off. I mean, the shares were closer to $16 not too long ago, but now trading just above that $8 mark. So we might start off with you. Gaurav, you haven't really been looking at the iron ore miners. What about some of the energy stocks?
Yeah, look, we've been pretty bullish on energy. Santos and Origin, I might add in there as well, are two companies that we've recommended. Somewhat with a few caveats, I have to say, because no matter what happens in these businesses, they are heavily exposed to the oil price. I mentioned companies with a few warts and a little bit of debt. Santos has an awful lot of debt and an awful lot of warts. The LNG project, on my numbers, will be a very low returning project. This isn't a business that's going to make a bonanza from LNG, but it is very cheap at the moment. And I think as oil prices normalise, and if you're a believer that oil needs to settle at about $80 the way I am, then I think Santos makes a sensible buy. But if you're not a bull on oil, then my goodness, stay away from Santos because it's very heavily exposed to that oil price.
Okay, so it depends on where the oil price is headed. I mean, Ben, would you be willing to make an investment in Santos?
I think you can't just take a long-term view on Santos because of the debt levels that Gaurav mentioned there. There is the potential that in this period of volatile pricing that the company is forced to raise equity capital, which will dilute everyone down and also sort of stymie the recovery that the share price has. So Santos in the major players would be the most leveraged to an improving oil price. If oil price just keeps slowly recovering from here, you'll get the best return out of it. If it really bounces around and potentially retests those lows, you might see a capital raising which sort of, you know, slows down the recovery. Origin is our preferred oil and gas stock, mainly because it's almost been priced like an oil gas stock, even though really at the moment it's pretty much a straight utility play. But it does have this APLNG project coming online over the next couple of years. But it is seen as the highest quality of the three Gladstone projects. I think it's got a good customer in Sinopec, which is also an equity owner, which I think is, you know, important. And I think it's got the best management under Grant King. He's got a sort of clear vision of where he's taking the company. And despite a lot of pessimism about cost blowouts and time blowouts, he really seems to have got the company through to where he said he would. So to me, that's probably the one, but it's probably the least aggressive one. And if you're looking more for that leverage, Santos would make sense.
Okay, so the energy place, an interesting place to be in at the moment. Hope that helps you out, Vic. We do have our next caller on the line, so let's go straight to John from Melbourne. John, welcome to the show. What's your question for our panel tonight?
Hi, Julia. Love your show.
Thanks.
I'd like to ask the opinion of the panel regarding Webjet, whether it's a good buy at the current levels.
Sure, this is an interesting one because Webjet, you know, over the past year it's up 49%, but over the last month it's actually down 12%. Now, not too long ago they did come out with their half-year numbers back in February. And brokers, a bit of a divided view here, Ben. There's 12-month predictions between $3.45 all the way up to $4.25. Stocks around about $3.50 at the moment. What are your thoughts on this?
It's one that you could take I could give you a bullish or bearish case. I mean, the market seems to have this ongoing opinion that they're going to get mown down eventually by international competitors, and also the full service agent seems to still be doing very well. I mean, Flight Centre had a phenomenal few months after a pretty ordinary year last year, and corporate travel management's going very well. So the stock looks cheap. They continue to deliver earnings results which exceed the market's expectations. It's very well managed. The guy, the CEO there, has been the CEO for a significant period of time. I reckon it probably looks all right, but I think you just got to have in the back of your mind that there is significant sort of risk that, you know, a superior sort of technological offering comes out and just takes Webjet out. And I think that's the concern and why it trades on that discount multiple. Like, if you look at What If as an example, they were in massive trouble. I mean, they got out, their shareholders got out of jail free with that takeover bid. If that hadn't happened, I think it was a really grim story. So I think the concern is something sort of similar happens with Webjet, but it's probably less apparent at this stage, would you say?
Look, I agree. It's a really tricky business, actually, because it does tick a lot of boxes. The valuation doesn't look too demanding. It's got a wonderful track record. Management's pretty good. I just can't answer the question why this business exists. I mean, you can get all the information you want from Webjet and then book on a different site and not have to pay their 10 or 12 bucks or whatever. And it's just... we've had this argument in the office so many times, and for me, a core part of any business is that it needs a purpose to exist. And I think this is a decent business that fulfills a lot of financial roles, and it ticks a lot of boxes, but it just doesn't tick the most important one. And so for me, it's just one that I can't put my money in, and it's always been an avoid for me.
So an interesting stock and an interesting response there from our panellists on Webjet. WEB is the stock code there. We are now going to go to our next caller. We've got Ian from Perth on the line. Ian, welcome to the show. What's your question tonight?
Thank you, Julia, and thank you for taking my call. Julia and gents, I'm after some information regarding Spark New Zealand, SPK. I'm looking at a long-term investment situation. Are they any value, and do they have a future? Thank you.
Sure. I mean, this is a stock where probably one of the most attractive things to investors is the yield, about 6.6% at the moment, Spark New Zealand. So not a massive capital gain in the past year, up only 3%. And in fact, over the last 3 months, it's down 15%. So down from $3.30 down to trading at $2.60 today. Gaurav, Sparking?
Look, it's not one I know particularly well. I actually looked at its off-cider chorus more closely. It was trading very cheaply a little while ago. This is more of a traditional regulated utility, and a 6-point-odd% yield actually makes me suspicious more than anything else. It seems a little bit too good to be true, and without knowing the business, I'd suggest you take a closer look at it, because the market is unlikely to give you a free kick like that, and it just seems a little bit too high.
Okay, so it seems too high. How about you, Ben?
I haven't really looked at it either. We do own a couple of companies that are like dual listed on the Kiwi exchange and the Australian exchange, and one thing I'd just say is probably a little bit of a concern there is the share price seems to have come back pretty heavily at a time when the Kiwi dollar's been rallying pretty strongly against the Aussie dollar, and therefore in an absolute sense on the Kiwi stock exchange that must the performance must have been pretty poor. Most Kiwi stocks over here doing quite well because the currency sort of helped.
Sure.
But look, I haven't looked into it much further than that, Julia, so I wouldn't probably want to say too much more. I mean, the two that we do like that are on their exchange are Auckland International Airport's one of our biggest sort of holdings, and Fisher & Paykel Healthcare. There's been another company that's done really well in the sleep apnea sort of space, and sort of both those businesses we still quite like at current share prices.
Okay, so an interesting company, Spark New Zealand, SPK, given the yield, 6.6%, compared to the largest utilities on the Australian market, which is AGL Energy, although it is down 2% in the past year, a yield of 4.2%. But not too much there, but Ben's saying that he's interested in some of the other New Zealand companies like FKP Property and the other one that was FPH
and AIA.
AIA, which is Auckland Airport. So a couple of other options there in New Zealand, which are both traded in Australia as well. We will be back with more after this short break, but if you'd like to speak to that expert panel, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
With the Australian Super 5-minute Super Sort Out, you can check how much money you have in super compared to other people. See the difference super could make to your income when you retire, and use our free online tools to see how to get there. You can even bring all your super accounts together, all in just 5 minutes. You could end up thousands better off. So get your super sorted now at australiansuper.com/sorted. It's Australian and it's super.
Down here, there's a lot to take care of. There's the meetings, the deadlines, the phone call you promised your mother, your gym bag full of wishful thinking, and your 2-hour park in a 1-hour space. But up here, everything's taken care of.
Shiraz or Riesling, sir?
Especially you.
Shiraz, please.
With food, checked baggage, and entertainment now complimentary on Virgin Australia domestic flights.
So, do we or don't we?
5 years ago, we would have jumped on this.
Buongiorno.
It's a great business you have here. What's your secret?
La nave nel porto è al sicuro, ma non è per questo che è stata costruita.
He said a ship in the harbour is safe, but that's not what ships are built for.
Australian business. See more, not less. NAB.
If you were me, what would you do next?
Start another business, build another website.
Hey, Heidi Highs, Heidi Lows, Heidi Weizen.
So 2014.
That's it.
With Wix, it's easy to create your own stunning website.
Heidi Whitey's.
You did this all by yourself?
Would I try them on?
Go to Wix and create your site today.
The world is right behind me.
about challenging yourself. No.
The best things in this world should be easy to learn and difficult to master.
The world's innovations need more nurturing.
The world is what you make it. ANZ. Your world, your way.
Want more? Get more with Series 2 Pulsar, STL and Triple S. With free stamp duty, free registration, free compulsory third-party insurance, and free scheduled servicing up to 3 years. See Innocent Dealer now.
The day before the budget, he labelled Joe Hockey a lame duck treasurer.
We've got tax going up, deficit going up.
Wednesday, why Labor promises a better fiscal future. Chris Bowen's budget reply address to the national press on Sky News Live.
I reckon.
Welcome back to the shares edition of Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can email yourmoney@skynews.com.au. And we do have our next caller on the line. One of our favourites, Abe from Sydney. Welcome to the show. What's your question tonight for our panel?
I'd like to ask the panel about two stocks, Seven Media. They're offering some rights issue. Does the panel think that it's worthwhile participating in them? Sure. And RMD ResMed, they've been hammered lately. They're trading around $7. Does the panel think they're good value at this level?
Okay, some good questions coming through from Abe. Seven West Media, the rights issue, and ResMed. Let's start off with the Seven West Media question. Rights issue, discounted. Would you be participating, Gaurav?
Let me make sure I get the right Seven West. So this is the Seven West that owns the Westtrack business and the oil interests as well.
No, that's Seven Group.
That's Seven Group.
Yeah,
this is the Seven.
West Australian newspapers.
Okay.
It's Channel 7.
Good. Well, the good news is that I think they're both stuffed. So it doesn't matter which one they're talking about. But,
so it's a sell.
So anyway. it's a sell either way. Yeah, if it's got a 7 in front of it, just offload it.
Okay, so the conditional retail entitlement offer. What do you think then?
I don't like Seven West Media. I think you know, I think on the television side, it's just going to get harder and harder for these guys with the. You know, I'm not saying anything, there's no rocket science here, but, you know, I've got a Netflix account now, it's awesome, and we're watching a lot less free-to-air TV than we ever used to watch. You know, I think there's more and more options to people. And then on the West Australian newspapers business, I think that was always a pretty mature, sort of softly sort of business. So I don't really like that one, Julia.
So if you were in the stock, you wouldn't participate in the rights issue?
I think if you've got to look at what the gap is, and I'm not sure, but if you didn't want to lift your exposure and the rights are being issued at a sufficient discount to the current share price, it could be worth selling, you know, some shares and then taking it back up in the rights, not increasing a stake and pulling a bit of money out of your holding. But I wouldn't probably be advising people to add to the holding. You know, if anything, I wouldn't be there at all. I did just read Kerry Stokes' autobiography. I was pretty amazed at it. Have you read it?
I haven't read it, no.
Yeah, it's really good.
Yeah.
Like, it does teach you some pretty good lessons if, you know, if anyone gets the chance to. And Seven Group, I probably wouldn't write him off. I mean, they're really moving into the energy sector, and when you look at his last sort of 40 years as a businessman, his ability to be a contrarian and buy things when they're cheap that he believes will do well and sell at peaks of very good at recycling assets. And
just that Westtrack business, though, that really,
it's in trouble.
It's in a lot of trouble. I'm not sure it's really reflected in the share price.
Yeah, I think that's right.
There's a lot of pain to be felt there.
Yeah.
And a really good point by Ben, because he was saying, you know, if there is a discount, then maybe sell off some of your existing portion and take up the rights.
Yeah, because that is worth something. That
it does look like it's at $1.25 from what I'm reading at the moment, and share price $1.20. So it does look like since they launched the offer, we've actually seen the share price come back.
Yeah, well, then you definitely wouldn't take it because you just buy more shares on market if you like the stock.
Absolutely.
Yeah.
Now, the other part of the question was ResMed. This is an interesting one. A big fall, you know, sleep apnea, sleep devices, supposed to help people with things like, you know, weight, longevity, heart attacks. And unfortunately, this study that was done kind of had the opposite effect. So, Ben, what do you think of ResMed at the moment?
Well, I think it's firstly just important to understand why the stock's taken this big fall, which was ResMed had a new potential product in ventilation that they were hoping would help patients who have had one cardiac arrest, stop them from having a second one. There's been an ongoing clinical trial looking at this. The company's been excited about it. Analysts have certainly been excited about it and have built sort of, you know, their price targets around that. The trial had to be stopped early because, ironically, their ventilation system was actually speeding up the rate of mortality in the patients in the trial. So that's never a good look. But I must be at pains to point out that it doesn't affect the existing business. It more means that a potential new revenue stream for the business has been removed, and that, I guess, has seen some sort of a PE contraction as a result. I think it's probably come back to about fair value, Julia, would be the long answer. We own ResMed, and, you know, at the right price we'd be considering topping up, but we have owned it for a number of years and it's a pretty decent sized holding for us, so it would have to be a pretty good price for us to buy some more.
Okay, yes, because I think it impacts on around about 2% of current revenue, but I guess the big question mark is on growth, which is why ResMed's been trading at a premium. What are your thoughts?
Yeah, it's been a long-term buy for us for a long time, and we've recently said it's looking a little bit peaky. I mean, I echo what Ben said. We're talking about a $50 million revenue impact, and it's led to a $1 billion share market fall. And it may speak to some share market irrationality, perhaps, but I think it also speaks to the frothiness of the ResMed share price. There was certainly a lot of high expectations being built into that share price. And having come off now, I don't think it's a bargain. It's probably around fair value. It's a wonderful business, and on any pullback, it's one of the first things we do. We go straight to it and look at it carefully. I think it's just fair value for now, so it's a hold for me.
I would say we've seen this in a lot of businesses, in that results have come in and you've seen these really big knee-jerk reactions. It probably points to the point that the market wasn't pricing the business correctly prior to when this announcement came out. ResMed was trading on about mid-20s in terms of an earnings multiple. Historically, it's traded on high teens, so, you know, you could argue it was just overvalued, and a little bit of negative news will create a big fall, and we've seen that, you know, quite a lot of stocks, you know, I think over the last 6 months. And it's not so much necessarily, I think, big stuff up at a management level, but more maybe the market's just stuffed up in terms of where they're pricing it to start with.
Okay, so mispricing and maybe correct pricing happening in the market at the moment. Let's go to our next caller. We have Peter on the line from Tasmania. Peter, welcome to the show. What's your question tonight?
Oh, hello, Julia. It's on AKZ.
Okay, so...
sorry, AZK.
AZK.
My apologies, AZK.
Okay, this is a bit of an unusual one from memory. I think they're taking over BrainChip, and previously a mining company, so Metals-X has a substantial holding in the company, but they're backing a capital raising for this reverse takeover of BrainChip that's happening at the moment. $44 million market capitalisation, stock spiked. If we can bring up the chart, this is an interesting one. AZK is the stock code. Spiked all the way up to 62.5 cents. It's currently pulled back to 21.5 cents, as you can see here. So it does look like they are doing a takeover, a reverse takeover of BrainChip, which is, I don't know much about neural technology, unfortunately, but I'm hoping that one of you do.
Luckily, I moonlight as neurosurgeon.
Oh, excellent. Over to you, Gaurav.
Look, I don't know the business at all, so I won't comment on the business, but just be very careful when you see companies suddenly change industries. I remember during the teeth of the commodities boom, there was a seafood business that was retailing prawns and fish. And then investors in that business woke up one morning to find that they were owned some sort of copper mine.
Sam Seafood?
Sam Seafood, yeah. That was the one. Yeah. I mean, this is a classic sign of get out of here. You know, it's an awful indicator for investors. And every time we see a sudden change in company direction, for me, it's almost an automatic trigger to get out of the stock.
Okay. Ben?
I can't add too much to that, I don't think, Julia. I mean, I think also you'd maybe sort of wonder why the vendors are selling into this business if they think it's got really, you know, sort of great opportunities. There's you know, if it's a tech sort of business, there's plenty of capital that can be raised in the private space if you know, investors think that you've got something that looks seriously good. And, you know, what is the sort of the motivation to sell to this new company? Because you often find really it's a way for the vendors to get out and to monetize the asset they've got. And if they believe that there's great things ahead for this business, why would they sort of allow a whole lot of small shareholders to come on and share in those spoils? It just wouldn't, to me, make much sense. So, you know, I'd be pretty wary of it from the sound of it.
Okay, so maybe do your homework. And like any development company, it's all about commercialisation, how long till commercialisation.
Yeah, cash flow, like so check the cash flow statements, because inevitably when you see those big spikes, you will normally see a capital raising very quickly.
Which we have seen.
Oh, okay, yeah, well, there you go. So, you know, it's always sort of, you see this play out just every single time. You could write books about it, yeah.
Okay, so we are seeing Metals X underwriting that capital raising, but that big spike up, and then we've seen a pretty big pullback for AZK, the stock code there. We do have to take a break, but we'll be back with more after this short break. If you'd like to speak with our expert panel, now's the time to give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
With the Australian Super 5-minute Super Sort Out, you can check how much money you have in super compared to other people. See the difference super could make to your income when you retire, and use our free online tools to see how to get there. You can even bring all your super accounts together, all in just 5 minutes. You could end up thousands better off. So get your super sorted now at australiansuper.com/sorted. It's Australian and it's super.
Down here, there's a lot to take care of. There's the meetings, the deadlines, the phone call you promised your mother, your gym bag full of wishful thinking, and your 2-hour park in a 1-hour space. But up here, everything's taken care of.
Shiraz or Riesling, sir?
Especially you.
Shiraz, please.
With food, checked baggage, and entertainment now complimentary on Virgin Australia domestic flights.
To be a trader, you need that spark inside. The courage, vision, and determination. The eye to see opportunity, and the wit to seize the right one. IG.
What we need is a much broader range and far less options, and if we can have a succession plan for the future, because
I'm focusing on today. The fact is, our opportunity is China. It's definitely Japan.
Undoubtedly the next suburb, because of
Cash flow, getting money in ASAP, and then
getting bigger and much smaller and
borrowing the money to expand online. I feel like our world's full of possibilities.
Every business has its own unique opportunities. Talk to ANZ, the bank that can help your business take the next step your way.
Welcome back to the program. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we have Ben Clark from TMS Capital and also Gaurav Sodhi from Intelligent Investor. So if you have a question you'd like answered, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au. Our next caller is Andrew from Melbourne. Andrew, welcome to the program. What's your question tonight?
Hi, Julia. How are you?
just got a question about Harvey Norman in terms of the short term and long term.
Sure, great question. Harvey Norman, I mean, housing boom going on, share price has been doing quite well in 2015, but where to next? We'll start off with you, Gaurav. What do you think?
This is one I've gotten completely wrong over the last 2 years. We've been very negative on Harvey Norman, and it's done extremely well. So maybe not follow my advice on this one, but this is a very tricky business to value. The property, everyone looks at the property on the books of this business and thinks it's always cheap, and I think that's a mistake. As Tesco in the UK is showing, property values are intimately tied to the value of the retail operation, and if the retail operation loses value, so does the property. So for me, look, I'm going to sit on the fence on this one. I understand that there's a big boom in construction going on, and that helps with sales, but long term there are just a lot of problems in the retail sector. I think the retail sector in Australia has been over-earning for a long time. There's a lot of competition now entering the market, and I'm not even talking about the internet, I'm just talking about regular new stores opening from overseas. And I think existing retailers are really going to struggle to adapt to this very new competitive world, and that includes Harvey Norman. They're getting a bit of a cyclical bump at the moment from the construction boom, but post that, I can't be positive on the stock, unfortunately.
Sure, and this is a housing boom story. I mean, Harvey Norman up 44% over the past year. You know, Nick Scali, a small company, up by 36%. Beacon Lighting's another one that's been doing well. They're up so much already, you know, it's already priced in. What next?
Well, you know, everyone gets this $20,000 small business concession, and Gerry Harvey, I mean, good point. You can say what you want about, you know, I think he's been a great businessman over the years. What I do like about him is he's always honest, and he'll say when times are bad, he'll tell you how bad they are. And he did say after the budget, this was probably the biggest announcement in Harvey Norman's history. Wow. So, you know, I think, you know, I think in the short term, the business probably looks really good. There's a lot of construction happening, but there's still a lot of people that haven't moved into those apartments, etc., and are yet to furnish. And I'm sure that they're going to benefit from that, plus this small business concession. But as Gaurav said there, it's a highly cyclical business. We're probably maybe 6 months away from the peak of the cycle, although no one will ever know until we look back and say that was the peak. And the peak in the share price will always happen before the peak in the cycle, because the market's already factored all this, what I'm talking about, in. And you know, like we said, you know, there's double leverage because they've also got rising property prices at the same time that all their customers have rising property prices and buying. So, you know, I would be really careful about buying Harvey Norman at these share prices.
Okay, so I guess a little bit of cautiousness in terms of Harvey Norman, given that it has risen strongly and the retail sector is still a pretty difficult place to be in, although it does demonstrate that, you know, sometimes the cyclical factors can outweigh some of the structural problems that we're seeing and some of these great share price performances that we have been seeing. Let's go to our next caller. We have Greg on the line from Brisbane. And Greg, welcome to the show. What's your question tonight?
Thanks very much, and hello. I was wanting to find out about Phlogica, Phlogica, and cheap shares at the moment, just to see what the long-term prospects were like, and also car sales to hold on to. Thanks.
Sure. So a couple of questions there. PYC, Phlogica, as well as car sales. Phlogica, a very small company, $30 million market capitalisation. I have to admit I've taken a punt on this one. Just my play money, because biotech space is quite difficult, and we have seen a pretty big surge on the back of a study that they did with a breast cancer drug where using their library of molecules, they did have great success in breast cancer that previously wasn't able to be killed and was resistant to drugs. Share price spiked about 50%, and of course now we've seen a capital raising, so it does look like actually looking at Phlogica, I thought it was trading ex entitlements, but it might be another company there. It doesn't look
gazing into the future.
I might be gazing into the future. No capital raising that I can see at the moment. But the share price has pulled back to 2.7 cents. So I guess like any biotech company that's in development, pretty difficult until it gets to commercialization or a takeover, both of which I'm hoping for. Any thoughts on this one?
Julia, what are you doing?
Yeah, I usually do stay away from biotechs, but I do like a punt every now and then.
I don't mind a punt. I mean, I understand the idea of a punt. I take punts myself, but in my view, unless you have some sort of intimate knowledge on medical science or on molecules, you have no business buying into a pre-commercialization biotech. There are people out there with far more knowledge, far more intimate knowledge, looking at this business, making judgments about it. And for you as a rank amateur, to take a blind punt is frankly like going onto a tennis court, picking up a racket for the first time and trying to beat Roger Federer. It's just, it's madness. I can't understand why people do it. And if you're doing it, then stop it.
Most of my portfolio's doing well. I still like having a little bit of fun on the side. The other question was around car sales.
Yep. Just one thing I'll say on Philogica is, like, if you are trading them, like from what I've seen over the years, is you've got to do your research, wait for liquidity to dry right up, be able to look ahead and see that, yes, there is going to be an announcement in 4, 5, 6 months about a potential trial outcome. That's the time you want to be buying them. If you like what you think could come out of that trial is when no one wants to know about it, it's too far away and no shares are trading. And the day that you sell it is the day that they come out with some sort of positive news. Everyone piles into it. That's the day you should be selling. And so often people do the exact opposite, where they buy on the excitement, the share price drifts off, the capital raising comes through, the share price drifts off further, they give up on it and they walk away. And so that's one thing I just sort of say, because I think it really is psychology and herd mentality is a big part in these share prices. Car sales is a business we own and I think is a good long-term sort of punt. But I would say that this small business concession I think is going to be good news for car sales in the short term. I'm sure there's a lot of guys going out there buying $20,000 utes. We've seen AP Eagers and Automotive Holdings have both spiked up on the back of this announcement. And that should benefit car sales as well, particularly in the second-hand car market, because it is capped at $20,000. A lot of car sales' future will be dictated by how well they execute on their international investments. They came a lot later to the party than, say, a Seek in terms of the prices they paid, and they really need to show the market that they're going to be good long-term buys as a result. But the proof's going to be in the pudding. For the moment, we're happy to hold.
Okay, and we've seen a spike up in terms of car sales on the back of that budget announcement. Would you be buying?
Car sales is very close to a buy for us, not quite there. Look, price isn't a huge deal with car sales. I mean, it is such a large, strong moat that they have around their business. Their domestic operations are almost impenetrable. It's really the international operations we need to worry about. That's where all the risk in the business really lies. And I think it's a great portfolio, actually, of international sites. The South Korean business is a market leader. The Brazilian business is really in its infancy. And I think there's a long runway of growth for car sales. I like it quite a bit. It's not something you have to watch every cent with, because there is so much growth and it's such a strong franchise. You know, it's a hold for me, but it's very close to being an upgrade.
Okay, so that was car sales and PYC. Let's go to our next caller. We've got Simon on the line from Gosford. Simon, welcome to the show. What's your question tonight?
Thanks, Julia. Look, I've just become a little bit interested in this so-called theme of Australia as the food bowl of Asia. And I've been having a bit of a look at Elders Limited. Could you get Ben and Jewett to tell me what they think Elders' long-term view is? Has it turned around sufficiently? Been on a bit of a tear in the last few weeks.
Sure.
And perhaps, is there any other stocks that are leveraged to that theme that they might think I could have a look at? Thank you.
Sure. I mean, agricultural stocks have always been quite difficult. Lots of ups, lots of downs. You only have to look at GrainCorp to see how difficult it can get. But Elders is a different story at the moment. Big turnaround, had a recapitalisation last year, cut a lot of its debt. The stock's up 260% over the past 52 weeks, so reflecting that turnaround. The big question is, there more to go? We have seen livestock prices, although they've been near record highs recently, still taking a little bit of a pullback. So, Ben, what are your thoughts on Elders?
Yeah, look, I mean, they've actually just updated, I think they just reported like a day or two ago, and that the result came in ahead of expectations. And the new CEO, he was actually the chairman of Elders prior, he came in and he set a very aggressive target of $60 million in EBIT by 2017, and it actually looks like they're on track potentially to achieve that. And if they do achieve that, then the stock still does look quite cheap, I think. We're not in it, mainly because, as you said there, Julia, it is, you know, the conditions in the bush and the agricultural sort of game are inherently seasonal, volatile, and year to year sort of very hard to work out. I mean, we saw also today a profit downgrade from Bega Cheese, you know, which was sort of a market darling after the Warrnambool cheese and butter thing. And the thing we grapple with is a lot of these agricultural stocks trade on really high valuations, and we don't think sort of reflect how tough it is for these guys to continually sort of make money. And I think, you know, in a lot of cases there's a lot of strategic value put on the assets as opposed to, you know, normalised earnings. Like the Warrnambool cheese and butter, that just went for, I still can't believe the price that went for. But to someone it's worth that, maybe not so much because of the profits that they'll get, but because locking in those assets has repercussions for other assets that they own. And you saw with GrainCorp, you know, the takeover bit that came through there, which was also very highly priced, and we've since seen a profit downgrade in GrainCorp. So I like the theme of the food bowl, the agricultural thing, but it's really up and down, and it's hard to find a business that sort of has better sort of metrics. I don't know. Have you found one, Gaurav?
I just don't know if agricultural businesses can make money over time. And I think one of the reasons for that is that the lags for agriculture are so much smaller. You know, they're very responsive to price changes. I mean, we've just been through a galactic commodities boom, and it takes, you know, 10, 15 years for a supply response after commodity prices, hard commodity prices to rise. Soft commodity prices aren't like that. Grain can be grown in a season. It's very quick to respond. So long-term profits in these sectors are, I think, are really difficult, almost impossible. I'm not sure a lot of these businesses should be listed at all. I think they work far better in private hands. You're correct about the asset price. I think most of them trade on asset value or strategic asset value. In that case, they're better off in private hands rather than public hands. And I just haven't really had a success in this area, and I must sheepishly admit I've sworn off it. But look, Elders, I'll take a look at that when I get back into the office. I think it does look interesting.
Okay. If there was one I'd probably pick, it would be GrainCorp. And I think you want to buy it when it's had the bad season. You know, it's like what I was saying about biotech stocks. You know, you buy them when conditions are really grim in the bush, and you sell them when they're really good. They're probably not great long-term investments, as Gaurav was saying there. So, but I do think that they've got great assets. They've still got this American company on the register. Maybe they'll have another crack at some stage, but that's probably the one for me.
Okay, so GrainCorp. So the agricultural stocks do tend to be cyclical, and of course GrainCorp, a bit of a downturn at the moment. So Ben's saying buy during the downturns rather than the peaks. We are going to take a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au.
With the Australian Super 5-minute Super Sort Out, you can check how much money you have in super compared to other people. See the difference super could make to your income when you retire, and use our free online tools to see how to get there. You can even bring all your super accounts together, all in just 5 minutes. You could end up thousands better off. So get your super sorted now at australiansuper.com/sorted. It's Australian and it's super.
Down here, there's a lot to take care of. There's the meetings, the deadlines, the phone call you promised your mother, your gym bag full of wishful thinking, and your 2-hour park in a 1-hour space. But up here, everything's taken care of.
Shiraz or Riesling, sir?
Especially you.
Shiraz, please.
With food, checked baggage, and entertainment now complimentary on Virgin Australia domestic flights.
To be a trader, you need that spark inside. The courage, vision, and determination. The eye to see opportunity, and the wit to seize the right one. IG.
remarkable. Greatest temporary when glory lasts forever. Loving this. He's loving the contest. Will it be a fair return? He's going to smash it. Double magnificent. Something to savour. Something to remember for the rest of your life. What a legend. What a champion.
The world is right behind me.
The world is a beautiful piece of engineering.
The world is about challenging yourself.
The world is what you make it. ANZ, your world, your way.
This program brought to you by the Australian Super 5-Minute Super Sort Out.
Welcome back to the show. If you have a question you'd like answered, please pick up the phone and give us a call on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And we have our next caller on the line. Let's go straight to David from Brisbane. David, welcome to the show. What's your question tonight?
Hi, panel. My stock tonight is IMF Bentham. It's definitely a unique stock for the Australian market, and I was hoping to get the panel's view on the business model, its future prospects, and whether the current price presents a good entry point. Thanks.
Sure. I mean, IMF for a long time performed very well. Unfortunately, over the last 3 months, we've seen a significant pullback in terms of the shares. Just having a look, down 22% over the last 3 months.
I like that. I get quite excited when the share price falls. Now you're talking.
So, would you be buying at these levels?
I actually don't know the businesses at all. It's been sitting on my list of companies to look at.
So you only know
ages.
that it's fallen 22% over the last 3 months.
And that's why it's on my list. But I haven't actually got to it, so I'm really interested to hear what...
Well, yeah, we've been buying some of this, and so what they do is they're litigators, and what they do is they find potential lawsuits, many of which are against large companies. They then bring together a class action, and they fund it off their own balance sheet, but they bring in lawyers to argue the case. Generally, Morris Blackburn are the lawyers they use. They've been listed for a fair period of time. I think now up until that share price started falling, they'd argued something like 136 cases they brought forward, and they'd lost 6. Wow. And they've got a great business model where they take 30 to 40% of whatever the winnings are for a fairly minimal capital outlay. And where they've been doing very well is particularly picking up companies on lack of transparency. So ASIC have actually said that they quite like the business. Greg Medcraft on record said it helps us keep the market honest, and we don't have necessarily the resources to monitor all these things. They class action against Leighton, they recently won. Now, why they've pulled back, why they pulled back is they've lost three small cases recently, which is pretty, you know, the track record over 7 or 8 years is that that's very unusual. And they were minimal cases, but one was high profile, which was the case against ANZ for overcharging bank fees. They won that case initially, and then they lost on appeal. And that was going to be a pretty decent payout to them. But they've got, I like the business because you can actually look, and they've got about $700 million in potential winnings each year for the next 3 years of cases in the pipeline. The biggest one in the next year will be Wivenhoe Dam, which they believe is sort of guilty for the Queensland floods. They've got about $160 million in cash on their balance sheet, no debt, good management, and I think the market cap's at about 230, 250. And the one criticism, which is just this part of the model, is that cash flows are lumpy. You don't know which year wins are going to drop into, but the company's paid 10 cents fully franked pretty consistently for several years now, and they're now going to start looking at increasing that dividend, and that puts them on a good yield as well. So I like it, but it's a smaller business, it's more volatile, it's not for everyone, but I think it looks good. And I like that they can make money in good times and in bad times.
Okay, so Ben liking the stock, and it sounds like Gaurav now liking the stock.
I'll be looking at it. Look, the only thing I'm a little careful about is the prospect for competition. It's a market they've had pretty much to themselves. There's very low barriers to entry. Their success almost guarantees someone else will enter it and try and take some of those profits.
Absolutely.
And a competitor here will just bid up getting customers, and I think it could reduce profitability a lot.
I think that's probably true. They have moved into the UK and the US in the last year or so, and that's probably a signal that they're looking for more growth. And there's always also the threat of legislation in terms of class actions and what potential payouts there can be. But I still think at this price, you know, we've been buying at sort of 190s, and it's actually slipped a little bit further since then. I reckon that sort of factors in, you know, sort of that risk.
Okay, so that was IMF, and it is now time for a viewer email. We've got one here from Kurosh, and Kurosh writes, my question is regarding Magellan Financial Group. The share price came down from $21 to $17.65. Should I buy more or hold or sell? One of the darlings of the market. I mean, you look at the funds under management a couple of years ago compared to now, and it's just been amazing, the growth. Can it continue? It's still up 46% over the past year, even though it's down 16% over the past month. Gaurav, what do you think about this one?
I remember looking at this business when it was trading about $3, and I said, oh, it's far too expensive. So again, that shows you, A, what little I know about Magellan, but also B, how leveraged fund managers are to funds under management. And these businesses, Platinum is the same, Perpetual is the same. When money is coming in, earnings absolutely explode. I can't think of a more leveraged business than fund managers. The converse is also true. Once those funds start to reverse, if they start to reverse, earnings contract extremely quickly. And so the future for Magellan is about growing that funds under management, and they've been extremely successful. They've had some very large mandates coming in. It's run by these two very well-connected bankers who seem to know everyone and are very good at attracting new money. Their track record, up until recently, has been very good. I'm hesitant to buy into a fund manager after they've had a long period of success, because a bad year is only a year away. It's always around the corner, and it will have an impact on FUM, so I'd stay away for now.
Okay, so very leveraged to the market, and we have seen a bit of volatility in terms of the markets. Is now time to be buying, Ben?
Yeah, so I think one of the reasons the share price has come back is the last 2 months, I think, net flows into their fund have stalled, and this is, you know, just every month the flows were just extraordinary that they were getting, and I think the share price coming back sort of reflects the concern that maybe they're losing a bit of that momentum. I know Hamish Douglas has a target of $50 billion under management, and, you know, to be honest, I reckon he'll get there, because I think they've come up with a offering and an explanation to the financial planning community, particularly in Australia, that really only have Platinum, and I think there was some frustration with Platinum, that planners are bought in. I think a lot more money is going to go international in self-managed super funds, and these guys will be a big beneficiary, but it's going to be up and down along the way.
Okay, so that was Magellan Financial Group. Let's go to our last caller of the night. We have James from Sydney on the line. James, how can we help you out?
Yeah, good evening. I'm calling about Pact Group, PGH, and considering the time, hopefully we can squeeze in Treasury Group, TRG as well. Look, both are different sectors, but both companies have good, stable, reliable profit increases, both reasonable dividends, and both have been doing really well up until fairly recently, and I think they're ready to take off again. Just wondering what the panel thinks, what you all think of the companies, and what I've just commented on there. Thank you.
Sure. We've got about a minute 30, so let's stick with Pact Group. The stock has been moving sideways over the last 3 months at around about $4.20, finished at $4.15 today. Ben, what do you think of Pact?
Yeah, a couple of like Insto guys I've spoken to in the last couple of months have singled this company out as they reckon looks quite good. I had a look at a recent presentation. Their result in February was a bit disappointing, which is why I see the share price come back there. The stock does look cheap. I think it's on about sort of 13.5 times earnings. Wouldn't say there's a great deal of earnings growth there, Julia. And they do have, you know, one of their key sort of cost, which is in chemicals, etc., to manufacture, is out of their control, and that can really sort of swing around. So I think it looks cheap. You know, I probably want to see how they report in August, given that they disappointed in February and they're a pretty new entrant to our market, and probably have a rethink of it in August. I wouldn't rush into it at this stage.
Okay, so no rush there. How about you?
Yeah, look, I agree. There's not too much I can add. I wouldn't say it looks particularly cheap. It's I think there's sort of 0 to 2% revenue growth for this business. So I wouldn't be rushing to buy it either.
Okay, and on that note, that's all we have time for today. Thanks so much to our guests, Ben Clark from TMS Capital and Gaurav Sodhi from Intelligent Investor, and to you, our guests, for all your calls and your emails. Until next time, I'm Julia Lee from Bell Direct. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.